You've probably driven past a car wash and thought, at some point, that it looked like an easy business. Cars pull in dirty, they come out clean. Somebody pockets the difference. Low skill requirement, steady demand, a machine does most of the work. It's the kind of business people daydream about owning when they're tired of their real job.
That impression isn't wrong, exactly. It's just incomplete in a way that matters. The wash itself, the soap, the brushes, the 3 minutes of foam and rinse, is close to the least important part of how this industry actually makes money now. What's happened to car washes over the last decade is a case study in how an ordinary local service gets restructured into something that behaves more like a financial product than a business. Understanding how that restructuring works tells you something bigger about how a lot of modern consumer industries quietly get rebuilt underneath a familiar surface.
Start with the version most people still picture. You drive up, you pay per visit, maybe $8 or $12. An attendant or a machine runs your car through, you leave. Simple, transactional, done. For most of the 20th century, that's basically what a car wash was. A piece of equipment on a lot, generating revenue one car at a time.
That model still exists, but it's been pushed to the margins of the industry's growth. A well-located modern tunnel wash can gross between $1.5 million and $4 million a year, with operating margins in the 35 to 50% range. Those are extraordinary numbers for a business with a handful of employees and no inventory to speak of. But they didn't come from getting better at washing cars. They came from changing what the customer is actually buying. That change is the membership. Walk into almost any express tunnel wash today, and the pitch isn't pay per visit. It's a flat monthly fee, commonly somewhere in the $20 to $40 range depending on the tier, for unlimited washes at any location in the network. On the surface, this looks like a customer-friendly deal. Wash as often as you want for less than the price of 2 or 3 individual visits. And for the operator, it converts an unpredictable, weather-dependent, one-off transaction into a recurring subscription that lands in their bank account every month, whether or not the customer ever shows up. That last part is the whole trick. Industry data suggests the average member uses their unlimited wash plan somewhere between 1 and 3 times a month, nowhere near enough to actually need an unlimited plan. Only a small slice of subscribers, roughly 3 to 5%, use the service often enough for the membership to genuinely be the better deal. Everyone else is essentially paying a small recurring convenience fee for a benefit they mostly don't use. This is not an accident or a failure of the business model. It's the engine of it. A gym works the same way. Most members with unlimited access barely go, and the gym's entire unit economics depend on that gap between what's purchased and what's consumed. Car wash operators reinforce this deliberately. If you try to pay for a single wash without a membership at one of these tunnel locations, you'll often find the price has been pushed up to somewhere between $16 and $25, noticeably higher than it needs to be. That's not really a price for a wash. It's a nudge. When a single visit costs almost as much as a month of unlimited visits, the math pushes you towards subscribing, even if you know, deep down, you won't use it much. The membership isn't competing with the alternative of not washing your car. It's competing with the deliberately inflated price of washing it once. So here's the first correction to the popular version of this business. The product being sold isn't really a clean car. It's a recurring debit that's cheap enough and small enough that most people never bother to cancel it. The wash itself is almost incidental. It's the thing that makes the subscription feel justified enough to keep paying for. This is where a second layer of the business starts to matter, and it's one almost nobody thinks about when they picture a car wash: the ground it's sitting on. A tunnel wash needs a specific kind of real estate. Operators look for parcels around 3/4 of an acre to an acre and a half, ideally a corner lot. Ideally with high traffic counts and easy entry and exit, so cars can queue without backing onto the road. That's a narrow, competitive category of commercial land, the same kind of corner that fast food chains, pharmacies, and gas stations are also fighting over. And because that land is scarce and visible, it tends to appreciate independently of how well the car wash business on top of it performs. That distinction is worth sitting with. A car wash is really 2 assets stacked on top of each other. An operating business, which is volatile and depends on customer behavior, weather, and local competition, and a piece of commercial real estate, which tends to hold or gain value regardless of any of that.
Sophisticated investors have started underwriting car wash deals with that split explicitly in mind. They'll tolerate a mediocre wash business if the land under it is appreciating fast enough to cover the difference. That's a very different mental model than clean cars for money, and it explains why people with no interest in operations have poured money into this sector.
Put those two pieces together, a subscription model that profits from underuse and land that appreciates on its own, and you get a business that looks a lot less like a service and a lot more like a small, self-funding real estate and cash flow vehicle. That combination is exactly what caught the attention of a much bigger kind of buyer than the local entrepreneur.
Private equity noticed all of this around the same time interest rates hit historic lows, and what followed was less like normal industry growth and more like a land rush. Between roughly 2020 and 2022, financial sponsors moved into car washes aggressively. One investment group summarized the appeal bluntly. There's no other kind of operation on a single acre of land that can generate $1 to $2.5 million in annual sales while keeping roughly half of it. That kind of margin on that little land with that little labor is almost unheard of in retail real estate. Firms started buying up small regional chains, merging them, and building new locations at a rapid pace, all financed with cheap debt. The strategy is called a roll-up. Buy many small, fragmented operators, combine them under one brand and one back office, and sell the whole thing later at a much higher valuation multiple than any of the individual pieces could command alone. The logic works, right up until the cost of the debt funding it changes.
And it did change. As interest rates rose through 2022 and into 2023, the economics of the roll-up strategy started to strain. By the first half of 2024, the number of car wash deals being announced had fallen by roughly 46% compared to the same period 2 years earlier, and the number of individual sites changing hands had dropped nearly 40%. Firms that had bought aggressively during the cheap money years now owned assets with a high cost basis, and they needed unrealistically high valuations to hit their target returns, valuations the market was no longer willing to pay. A lot of platforms found themselves stuck, too large to sell easily, too indebted to wait comfortably, and increasingly dependent on new unit growth that was getting more expensive to finance.
That's the setup. Now here's where it plays out in full, in a single company that ended up as almost a textbook version of this entire chain reaction. In 2014, a private equity firm called Leonard Green & Partners bought a car wash operator that, at the time, was mostly just a well-run chain in a handful of states. What Leonard Green did with it over the following years is often credited with kickstarting the entire private equity wave in this industry. They didn't just expand the number of locations, they rebuilt the company around exactly the membership plus real estate model just described, effectively turning a one-off service business into what's now described in the industry as a car wash as a service platform. It worked. Revenue grew at a compound rate of around 17% a year, reaching close to $600 million in the 12 months before the company went public. And in June 2021, that company, Mr. Car Wash, listed on the New York Stock Exchange. The debut looked like vindication for the whole model. Priced at $15 a share, the stock jumped roughly 49% on its first day of trading, pushing the company's valuation above $6 billion by the closing bell. At the time, Mr. Car Wash controlled only about 5% of the market by location count, and the 10 largest operators combined controlled less than 10%, meaning investors weren't just buying a car wash chain. They were buying the idea that this fragmented, unglamorous industry was about to consolidate around a handful of winners, with Mr. positioned to be one of them. The stock was trading at roughly 25 times its earnings before interest, taxes, depreciation, and amortization, a multiple usually reserved for fast-growing technology companies, not a business whose product is rinsing sedans.
Then came the first warning sign, and it arrived almost immediately. In August 2021, just 2 months after the IPO, Mr. Car Wash reported its first quarterly results as a public company. The numbers were genuinely good, rising revenue, growing comparable sales, positive earnings, and the stock fell anyway, dropping through that week and continuing to slide afterward. That disconnect, strong operating results met with a falling share price, was the first sign that the public market's enthusiasm had outrun what the underlying business could actually deliver on a quarter-by-quarter basis. A subscription and real estate business built for patient, multi-year value creation was suddenly being graded every 90 days, and it didn't grade well under that lens.
From there, the gap between the operating business and the stock price only widened. And this is the part that should sound familiar by now, because it's the same tension baked into the membership model itself, a healthy-looking number hiding a weaker story underneath. Over the next several years, Mr. Car Wash did essentially everything right by its own internal metrics. It added more than 100 new locations, growing to over 500 sites nationwide, mostly by building new washes from scratch rather than through risky acquisitions. Membership subscriptions grew to account for more than 75% of total revenue, exactly the recurring sticky income stream the whole industry had been chasing. Total revenue climbed every single year and crossed $1 billion for the first time in 2025.
And the stock kept falling anyway. By early 2026, shares had dropped by nearly 70% from their 2021 peak of $23.53, and the company's market value had declined by more than 20% even in the prior 12 months alone. The valuation multiple that had once sat around 25 times earnings had compressed down to somewhere between 7 and 8 times, closer to what investors pay for a mature, low-growth utility than a supposed consolidation story. Analysts pointed to a specific mismatch. Building new locations from the ground up, rather than buying existing ones, requires heavy upfront spending and takes years for each site to reach full profitability, which drags down near-term margins in a way that public shareholders, focused on quarterly results, were unwilling to be patient with. The business kept getting bigger. The market kept deciding it was worth less.
That contradiction finally resolved itself in February 2026 when Leonard Green and Partners, the same firm that had built the company in the first place, agreed to take Mr. Car Wash private again in an all-cash deal valuing the company at about $3.1 billion in enterprise value at $7 a share. It was framed as a 29% premium over the stock's trading price in the months leading up to the announcement, which sounds generous until you remember that $7 was still less than half of the $15 IPO price from less than 5 years earlier, and a fraction of the $23.53 peak. The company came full circle, private, then public, then private again, run by the same sponsor the entire way, having grown its revenue and store count the whole time.
What does that prove about the broader system? It isn't a story about a bad business. The operating numbers were real, and they grew every year without interruption. It's a story about a mismatch between what kind of capital this business actually needs and what kind of capital the public markets are built to provide. A model that depends on opening new, unprofitable for a while locations on land that appreciates slowly, funded by a subscription base that quietly relies on people not using what they pay for, is a genuinely good long-term compounding machine. It is a genuinely uncomfortable fit for a stock market that reprices a company every 3 months based on the last 90 days of results. The public listing wasn't a mistake in the sense of losing money for the company. The underlying assets kept growing in value the entire time. It was a mismatch of time horizons, and eventually the ownership structure snapped back to whichever version could tolerate that mismatch. Private equity, which is built to wait.
The rest of the industry absorbed the lesson without needing to go through an IPO themselves. Through 2024 and 2025, deal-making slowed and became more selective. Rather than chasing every available site regardless of price, the operators still buying were consolidating around fewer, larger deals. The acquisition of a major regional chain's car wash business for roughly $385 million and about 380 locations in early 2025 is a good example of the shape deals started taking. Fewer transactions, but each one bigger and more strategically deliberate, rather than the scattershot land grabbing of a few years earlier. Firms that had overpaid during the low-rate years found themselves waiting for site maturation and friendlier borrowing conditions before attempting an exit, rather than rushing to sell into a market no longer willing to pay 2021-era multiples. So what does this actually mean if you're the person who still finds the idea of owning a car wash appealing? There are a few honest ways this plays out, and it's worth being clear-eyed about the range rather than only the best case.
The optimistic outcome is real and does happen. A well-sited single location on a strong corner, run efficiently with a healthy membership base, can throw off operating margins in the 35 to 50% range on a few $1,000,000 of annual revenue, while the underlying land quietly appreciates in the background. For an owner-operator willing to run the day-to-day, that's a genuinely attractive small business, closer to a cash-flowing piece of commercial real estate with a service business bolted on. The realistic middle outcome is closer to what most independent operators actually experience. Solid, but unspectacular margins, a membership base that churns more than expected, rising water, chemical, and equipment costs, and increasing competition as more tunnels get built nearby, since site scarcity works both ways. Everyone is fighting over the same limited pool of good corners, and that competition compresses returns as an area gets saturated.
And the negative outcome, the one the roll-up era made painfully visible, is what happens to an operator who buys or builds at the top of a cycle, financed with debt sized for optimistic growth assumptions, right as capital gets more expensive and site economics take longer to mature than the model assumed. That's not a hypothetical. It's the exact position a large share of private equity-backed platforms found themselves in through 2023 and 2024, holding assets with a cost basis too high to exit profitably and waiting, sometimes for years, for conditions to improve.
Which brings the story back to where it started. A car wash looks like a simple business. Dirty car goes in, clean car comes out. Money changes hands. But the version of this industry that's actually been generating the outsized returns over the last decade isn't selling cleanliness at all. It's running 3 overlapping businesses inside one storefront, a subscription model that profits from the gap between what people pay for and what they use, a real estate position on some of the most competitively valuable small commercial parcels in the country, and, for the largest players, a consolidation platform designed to be assembled and eventually sold to an even bigger buyer. The soap and the brushes are just the part you can see through the windshield. Everything that actually determines whether the business succeeds or fails is happening in the parking lot, in the fine print of the membership, and in a spreadsheet somewhere that has nothing to do with how clean your car gets.